Hi guys, welcome back. The data warehousing and AI company Snowflake was one of the hottest stocks during the pandemic. But since then, the stock has lost a lot of its momentum and is currently down by over 65% since their all-time highs in 2020. And a couple of weeks ago, Aquila5166 suggested the stocks in the comments. Thanks a lot for the great suggestion, Aquila. The business of the company is really interesting. And Seeking Alpha seems to have the same opinion, as Snowflake is currently one of the top-rated stocks from their quant system with a strong buy rating. So in this video, I will analyze what Snowflake exactly does, how their financials and valuations look like, and why I think that the company presentations are pretty misleading, if not borderline scammy. And if you're new here, my name is Florian. Thank you for joining me today. In the last 12 months, Snowflake did underperform the market with minus 2.5% versus the 7.5% of the S&P 500. And when we look at their performance since the IPO in September 2020, the picture is even worse. Snowflake's stock price did fall by 42% during this time, while the S&P 500 delivered almost 65% total returns. I mean, IPO stands for it's probably overpriced, and 2020 was a very good time for IPOs. So it is no surprise that the stock price did fall after its initial peak. But after a huge crash in 2022, the stock did mostly go sideways. And all that while at the same time, most of the fundamentals like revenue and free cash flow did grow very nicely. But their EBITDA is still negative and did even go down over time. I will explain why this is later in the video, and also how a negative EBITDA can lead to positive cash flows. But first, before looking at the financial details, we need to understand what Snowflake exactly does and also how they compare to Palantir that actually has a similar business model. Snowflake is a cloud-based data platform that enables companies to store, manage, and analyze vast amounts of data from different sources or data silos and in many different formats. As an independent company, they run on all major clouds like Amazon's AWS, Microsoft Azure, and also Google's cloud. This allows a seamless and quick data sharing and collaboration between different users, user groups, and even AI tools, while still keeping the data within your organization. That sounds very complicated, but actually it's not. Let's imagine for a second that we are Home Depot, that is actually a customer of Snowflake. Now, our data is scattered across different subsidiaries and many different systems. So it is hard to find any valuable information. Now, with Snowflake, we can, for example, move all our data from our website, our stores, our inventory system, and even our cash registers into Snowflake, so it's all in one place, and then we can start asking questions like which products sell best when the weather is good, or which of our stores in the state of New York has the worst profit margin overall. And Snowflake can actually find the answer within our data very quickly. It can also help to make forecasts such as how much stock of a certain item does a certain store need in May. So Snowflake essentially helps their customers to make smarter decisions by giving them a clearer picture of their own business by using their own data, regardless of the format or app you are using to generate this data. In contrast to most similar companies, Snowflake has a consumption-based business model which is typically paid upfront. So they bill their customers based on how much data they actually consume, rather than most software products that charge license costs per month and per user, what is called a seat-based pricing model. This is actually a big difference and will become important when we come to our forecast later in the video. So all in all, their products are very similar to Palantir's. But while Palantir is more of an end-user application with ready-made apps for highly regulated and secure areas such as defense, Snowflake is more for analysts, engineers, and data scientists who want to build their own solutions and need full control. And the demand for such services is growing very quickly. According to Technavio, the cloud data warehouse market has an annual growth rate of 43.6% between 2023 and 2028. This is because more and more data is created every day from an ever-growing count of different sources. So it is important to store, sort, and index this data properly if you want to use it to get any kind of insights out of it. And in addition to doing just this, cloud data warehouses also provide a platform that can run these analytics directly in a secure and controlled way. This data analytics market in itself is also growing very fast now, with a CAGR of 29% until 2020. So Snowflake is operating in markets with peculiar trends and can benefit from the huge and quick growth there. In their main market, the data warehousing market, they currently have a market share of 21%, which makes them the #1 company based on customer count, according to sixthsense.com. But this also brings some risks, because this market is a highly competitive one and Snowflake must face not only solutions from big cloud providers like AWS and Databricks, but also from individual self-made solutions. This drives the price pressure and increases the risk of being replaced. In my analysis, I found several mentions of Snowflake's products getting quite expensive, especially for larger workloads, which definitely poses a threat. But once you're locked in at customer side, the switching costs also become substantial due to Snowflake's ecosystem and the often customized nature of their apps. Overall, I think that Snowflake has a strong position right now, but this position is under constant threat. So now that we know what Snowflake does and how the general market looks like, let's dive into their financials. The revenue and the free cash flow show a very nice growth. The revenue especially is growing steadily every single quarter since their IPO. For the free cash flow, it looks a bit choppier due to the seasonality of the revenue, but on a year-over-year basis, it is also growing very nicely. The net income, EBITDA and EPS are still negative though, and the trend is actually pointing down. This looks a bit strange, doesn't it? So where does this difference come from? When we dive a bit deeper into their last 10K report for the fiscal year 2025, which ended in January 2025, so it's basically the calendar year 2024, we find nothing out of the ordinary in their free cash flow report. This is basically also what we have seen in TradingView. The quite low capex cost from development and property purchases are deducted from the cash from operations to give the free cash flow. They also mention the seasonality of the cash flow here that comes from a higher order volume, mostly in the last quarter of the year. But basically the main reason for the high free cash flows are their capex costs that are pretty low overall. It also helps that Snowflake's customers typically pay their bills, sometimes even for multi-year contracts in advance. These payments are recorded as deferred revenue and do not affect the GAAP earnings immediately, but are recognized over time. On the other hand, the operating costs are not included in the free cash flow, but they are included in the net income and EBITDA. And these costs are higher than the operating income, as we can see here, which pushes their net income into the red. A major part of these costs are the stock-based compensations. When we scroll down here, we can see that the stock-based compensation even make up 41% of their total revenue. And even though this is pretty common for high-growth software companies, it is still very high and way higher than what I like to see for my investments. Snowflake's expectation for the next years is that this will still further increase in total numbers, but that it will make up a lower percentage of their revenue because their revenue will grow even quicker. And as we just saw, their revenue growth is pretty remarkable. Over the last 5 years, they could grow it by almost 70% annually and their free cash flow by also pretty high 47%. Their EPS is negative and still declining though. This has also led to negative EBITDA margin and return of invested capital, even though their gross margin is at 65%. And because of the negative EBITDA, we also can't calculate the net debt to EBITDA ratio. And their total debt are quite significant with $6 billion. But the company also has 2.6 billion of cash on their hands, which lowers the risk a bit. But the debt itself usually isn't the problem. The interest expenses are. And these are still very low for Snowflake and only make up around 1% of their revenue. This is because they took on this debt in the form of several senior credit notes with very low interest rates, well below 0.1%. And these senior credit notes are still running until 2027 and 2029 respectively. So even though their EBITDA is still negative, at least for the next 2 years, this debt will not cause too many costs. Unfortunately, even though the company's management has authorized a share buyback program, they still issued more new shares every year. This has led to a share dilution of 1.7% per year for the last 4 years, which is a bit higher than the maximum of 1% that I like to see from my investments. And for my calculation here, I only used the data after January of 2022 to eliminate any effects from the IPO. But that was the past. What is the expectation for the next couple of years? There are many analysts that cover the company, and 41 of them give an average 1-year price target of $200, which is around 26% above the price today. As a minimum price target, they basically see the price today, and they even believe that the stock could reach its old temporary peak from the beginning of last year that is 50% above today's price. And this comes with an EPS growth of average 39% per year until 2028 and a revenue growth of 23% per year. So this doesn't look too bad on first glance, but remember that the EPS is still negative, and in the last 5 years we had an average revenue growth of almost 70% per year. And unfortunately, there are also some more negative signs. First, the company's retention rate that they call world-class here has been going down quarter over quarter. It might be world-class, I haven't double-checked this, but it did also decline by 5% in the last year alone. And if this trend continues, they for sure will not be world-class anymore in a couple of years. Then, in the annual report, they reported margin expansions for the last years. I already showed you the gross margin, the EBITDA margin and the return of invested capital before, and they were all negative. In this case, the margins they report are all positive. The difference is that they report the adjusted non-GAAP margins here, while I always look at the GAAP numbers first. And in this case, I have to say that I don't agree at all with what they adjust here. I'll show you what I mean in a second, but first, even in the case of their much adjusted margins, all of them have gone down last year. Remember, the company is currently already in the fiscal year 2026 and the fiscal year 2025 has ended in January, which is a bit confusing. So I think that this is already a tough situation to be in, and the current uncertainty on the market probably won't make it any better. Because if companies don't know what the future brings, they will probably hesitate a bit before investing in such new and expensive tools. And we can indeed already see the slowdown in acquisitions of large customers in the last quarter, where they only acquired 3 new customers from the Forbes Global 2000 list. So why do I think that their adjustments are misleading? Well, usually adjustments are used to exclude special or one-time effects that might skew the numbers otherwise. In the case of Snowflake, the biggest adjustment they make is related to their stock-based compensation, which is their biggest expense block and essential for them to hire new employees and grow their business. These are not special or one-time costs at all. They are directly related to their business. So the way how I see it, Snowflake just uses this to make an operating profit out of an operating loss, which I find borderline scamming. But maybe I'm just missing something here. So if you have any more insights on this, I'd be very happy to hear them down in the comments. Now, remember when I said earlier that their consumption-based price model will become important later? Well, now is the time. Because this does mean that the company doesn't have good control and visibility over what their customers actually consume. And in times of economic headwinds, I am concerned that their customers might dial down the usage of the platform to reduce costs, which might further hurt their revenue, margins and retention rate. But then, the same is true in the other direction if the economy recovers. So while I think that it is a risk in the short run, it might also be a positive factor when the times change again. And Snowflake itself also expects that their growth will go down in the current fiscal year. The margins are pretty stable with maybe a small decline, but these are again the non-GAAP margins. So I will not give too much on this. I'd be more interested in the original GAAP numbers here. And that brings me to the elephant in the room, the valuation. This is pretty high and way above the sector median with a non-GAAP PE ratio of 120 compared to 18.7, an EV to EBITDA of 83 compared to 12, and price to cash flow of almost 44 compared to 17. And even a price to earnings growth ratio of 3.6 compared to the sector median of 1.4. And yes, Snowflake is still a young and arguably quickly growing company. but I don't think that the risks I mentioned before justify this high valuation. Before I sum this up and come to my conclusion, let's also briefly compare them to some of their peers. And if you find this video helpful, please subscribe to the channel and hit the like button to not miss my next one. This really makes my day. And as a thank you, I promise you to read all of your comments and to reply to as many as possible. For today's peer comparison, I found it pretty hard to find suitable comparisons. Some of Snowflake's biggest competitors are parts of Amazon, Alphabet and Microsoft. But these companies have a much broader business model, so I don't think that it makes sense to include them here. Instead, I choose Palantir, MongoDB and Teradata. None of these companies has exactly the same business model as Snowflake, but at least they are active in a similar sector. So please take this comparison with a bit of care. Since December 2020, shortly after Snowflake's and Palantir's IPOs, Palantir had the best performance of this bunch with 292% total returns. All the other companies are actually in the red, with Snowflake having returned -52%. None of these companies is paying a dividend right now, so at least here we have the perfect comparison. And all of these companies except Teradata have quite high valuations. This makes a lot of sense because Snowflake was basically designed to disrupt Teradata's on-premise or hybrid data warehousing services. Palantir has the highest valuation, also when we look at the expected values for the next years. But Snowflake is not very far behind. Even the PEG ratio that includes the growth expectation is pretty high, especially for Snowflake and Palantir. This higher valuation is somewhat alleviated by the growth from these companies that on a forward basis is still in the double-digit range for revenue, EBITDA, EPS and also free cash flow. The numbers from Palantir do look a bit better than Snowflake's though, except the free cash flow. But as we already saw, this is to a large part because of the different business models. But profitability-wise and when looking at the GAAP numbers, Snowflake comes in at last by far. So all in all, similar to Palantir, I find the business pretty interesting and think that this is a huge growth area. This market is growing insanely quick and Snowflake has a good position here. But I am a bit skeptical of the execution. I am not sure if the consumption-based model is a great idea, and I rather like the lock-in effects and greater stability that licensing models provide. The stock-based compensation is also very high, and I really don't agree with their non-GAAP numbers that I find very misleading. In terms of the GAAP numbers, the company is not even profitable yet. In my opinion, this doesn't fit their high valuation. Even though the stock is already down by 65% from their all-time highs, this still doesn't seem to price in the current short-term risks. So, over the long run, I do like the company, but I just think that there are too many short-term risks to invest in them right now. But this is just my opinion. What do you think of the company and the sector? I'd be very interested to hear your thoughts down in the comments. And guys, the last weeks were pretty chaotic on the market, which made many private investors, including me, pretty nervous. In times like this, I like to look at 3 indicators that help me to make sense of the market and decide what to do. If this is something that sounds helpful for you, I have exactly the right video for you here. And this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.